Hello everybody, this is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. This video is going to take a deep dive into the dangers of overvaluation. I'm going to go through a lot of examples, and I'm going to go through many of them very quickly, but I've really got one message. I just want to try to give enough evidence here to illustrate that overvaluation can, and usually does, lead to very poor long-term rates of return. And I'm starting out here with a look at the S&P 500, because another thing that really disturbs me, we've been in a bull market for a long time now. You can see that after we went through the recession of 2008, the market has had a very strong advance, and starting in about 2013, the market has actually become increasingly overvalued, and it remains overvalued today. So beware of being a genius in a bull market, because I wanted this to set the framework. As I go through these graphs, I do want you to do a couple of things for me. At least accept the fact that this orange line on these graphs represent a calculation of fair value or fundamental true worth value of every business I'm going to go through here. I also want you to notice how stock prices tend to react to and track that orange line on the graph. So I'm going to start out here with my first example, which will be Albemarle, a company I've written about in the past. And this is a lithium producer. And what you see here is the stock price track earnings, which is the orange line, almost perfectly over this long period of time. And then with Tesla and all the lithium stuff, we had this very high valuation where PE ratios got up to 30. The company currently trades at an 18 PE ratio. And what that's led to since September of 2017 is a 33% drop in the company's stock price as it moves back into fair valuation. It's very easy to get excited about a stock that has this kind of short-term performance, but you also have to make sure you are relating that performance to the company's long-term valuation. Now, each of the companies I'm going to show you here have different lessons in valuation. Costco is a great example of that. This stock normally trades at a premium valuation, and in this case, it's the blue line in this graph, and you'll notice that that's a 24 PE, that's times operating earnings. Today, the stock trades at 32 times earnings. And we've definitely had a long correlation between this 24 times earnings, which I'm calling the normal PE. But in recent years, you've had this significant disconnect from that valuation level. I'm going to show you examples here as I go through these where that ultimately ends up badly. My next example is Cisco, and this is a classic case of course, a bubble. When Cisco and most tech stocks got into this bubble back in 1999 and 2000, we had PE ratios in the hundreds. And what's interesting in the couple of lessons here, we had an immediate correction, which happened in almost a year, where the stock price fell. I'm not going to hit it the perfect top here, but the stock price originally fell 75 to 80% or more. But then I also want you to notice that once the PE ratio kind of settled back into something, we'll call it more normal, we still had this long extended period of very poor performance. Cisco only averaged 2% a year, but if I take price off of this graph and look at the operating results of Cisco over this time frame, you can see that the company was growing very nicely. You can see the rates of growth here at the bottom of the graph, and yet because the price was so highly valued, there was no performance on the part of the investors. My next example is a recent example of General Mills, a company that has historically commanded a premium valuation. With a dividend producer like this, you can also look at valuation from the perspective of dividend yield. And these are year-end dividend yields. You can see in May of 2009, the company's dividend yield was 3.4%. And that was at a period where it had one of the lowest valuations of the time frame I'm showing you here in the graph. But then coming since that, we got into these very high valuations, and notice that the dividend yield was relatively low compared to historical norms when the valuation peaked here. But then from the peak, when the PE got up to over 24, aberrantly high relative to norms, we've now had a 2-year period where the stock has fallen over 40%. And that's significant. That turned $10,000 into $6,500 over that time frame. And that includes dividend income. So when you see periods of high valuation, the key is to be aware that those high valuations exist. I'm going to next look at Hormel Foods, and we have a very similar story where we see this high correlation at a premium valuation. The market likes to give this blue chip with very low debt and A rating. They like to price it at around 18 times earnings. My theoretical fair value is 15 times earnings, which, by the way, I want you to notice, you would have had several opportunities to buy it. But then we had this extended valuation where the PE got up to 29 times earnings, And since that peak valuation, we'll call it, you would have had very poor performance over this next year and a half or two, actually a negative minus 3.6%, and yet the company was still doing fine. Overvaluation will affect your long-term rates of return. This is actually one of the pure growth stocks I'm going to cover, Henry Schein. It doesn't pay a dividend. I want you to notice how highly correlated price was to this operating earnings. Here, I've got a fair value PE of 19. The PE got up into the high 20s, and once again, that led to a couple of years. We had this ultimate reversion to the mean, and that led to a period where you actually had a negative rate of return over a 2-year period. And what I'm also trying to illustrate here is you can see these valuation anomalies. They're very obvious, and that's why I say don't make the obvious mistake when you're looking at stocks. Similarly, you've got Illinois Toolworks here. It's a blue chip dividend payer, A+ rated. The market likes to apply a premium valuation to the stock, but that got to an extreme beginning of 2018, the end of 2017, and now we've seen this correction. The question is, will it go back down to a fair value PE of 15, or will it recover? But the point is, high valuation leads to poor performance, sometimes in the short run, but often also in the long run. Nordstrom is a really interesting case because we see where valuation got excessively high in 2007, just before the recession, and then when a stock is highly valued like this, it's very vulnerable to any kind of bad news. And you can see that once the recession came, this stock lost almost 75% of its value. Now, as we came out of the recession, the economy recovered. We once again got up into a high multiple for this stock, significantly higher than normal. And then again, we had some poor operating performance, and we ended up with another 50% drop in valuation. Overvaluation is something you can recognize and see, but it's also important to know that high valuation exposes you to even the hint of bad news. I've talked about this many times. Next, I'm going to take a quick look at Kimberly-Clark. Again, another blue chip dividend grower, dividend aristocrat that the market typically does apply a high valuation to, but once the valuation got extreme, like it did in March of 2016, we ended up with a 21% drop in value over the next 2 years, simply because valuation was high. Now, the company continued to perform well during that period. They continued to raise their dividend, but performance over an extended 2-year period was very poor. Here we've got L Brands, an apparel retailer, again, very similar to what we saw with Nordstrom. We had this irrational exuberance where the valuations got crazy up here at the 25 times earnings. Today, you can buy all you want at 10 times earnings with a 7% yield, but the end result was this extremely high valuation led to almost a 66% drop in the value of the stock. Otherwise, look how the price correlates to the company's operating results. Again, vulnerable to bad news. I love the Medtronic story because it really gives a couple of very interesting pictures about valuation. I'm going to cut a year off of here because I want you to see that in April of 2002, it was trading at almost a 37 PE ratio. And even though the business did fabulous, it grew by 16, 14, 19, 9, 8%. Those are great growth rates. The stock did absolutely nothing, averaged a 3.9% rate of return over this 5 or 6 year period here. Then, of course, the correction came, and we were able to buy this stock. If you had the presence of mind, you could have bought this stock at very low valuations. And now we're moderately overvalued again, but these low valuations led to 17, 18% rates of return. Valuation matters a lot when you're investing in common stocks. A very popular stock, of course, is Altria or Philip Morris. I'm going to draw this as a shorter term graph after the spin-off of Kraft and Philip Morris International. And again, you see very normal valuations here. A 15 PE was a good solid valuation. There were times when the PE coming out of the recession got down to 9 or 10, and then we had the PE get high again into the 20s. And once again, even from here to here, you have very poor performance, 4.5%, when the stock, simply as a function of overvaluation. You can see that correction. Buy the stock at a normal valuation, and even after this correction, you end up making 15.5%. Valuation is going to have a major impact on what rate of return you get, coupled with how fast the company is actually growing. Here I covered Microsoft last week in my most recent article, and I want to point out a couple of things that's very similar to Medtronic. Once you had high valuation, this company floundered for years. There was absolutely no performance in owning Microsoft. in all these years at less than a 1%, a 0.3% annualized rate of return. Everybody wants to blame that on Steve Ballmer, but actually the company actually did great. Now we have this excessive valuation on the stock, and when I shorten the time frame, you can see that it's normally a 15 times earnings company. It's now trading up. Everyone calls it now it's transformed into a growth stock. But the point is, these growth rates, although they're extraordinary, including the forecasting growth rates, which are extraordinary, are estimated to be about 14% by a very large consensus of analysts, still leads to very poor performance. If this stock was to go back to that 15 PE ratio, which I think it inevitably will, you've got a 5% rate of return. Even if it trades at its higher normal multiple of 18, you'd still have less than a 1% rate of return for the next 3 years. The company is selling at a valuation that far exceeds what the numbers will justify, and the numbers, the forecast growth rate, is quite good for this company. Next, I'm going to go into NextEra Energy. I want to talk about this a little bit. I own this stock, have an average cost of about $55 in the stock. I purchased it approximately in 2011 here when it was undervalued. And then now we've got this high valuation. I'm still holding the stock because it has great momentum and it's obviously very well thought of. But the reality of it is its earnings growth rate over this time frame is about what it's historically been. And that doesn't justify this high valuation. Forecast growth is a little better at almost 10%, but that still doesn't justify paying 23 times earnings for this really great utility stock, because you're exposing yourself to very poor long-term rates of return going forward. Realty income, I'm going to draw this with funds from operations using the proper metric. This is probably the most favored REIT of all, and you can really see the effects of what overvaluation can mean to short-term and even longer-term performance. Here we had the stock trading at very high multiples of FFO, and then we've had this correction. I still consider this one moderately overvalued even today, but it's certainly a lot more attractively valued today than it was back in 2016. With my next example, I'm going to take a look at Omnicom Group, and I'm going to go back to adjusted operating earnings here. And what I want you to see once again is that this company has a couple of these long valuation stories. We had high valuations back in 1999 and 2000. Again, that led to very long extended periods of negative performance. We once again got into high valuations in 2013. And again, that's led to very poor performance over this 3 or 4 year period. And all of that is happening, and this is so important, all of that is happening when the company is actually performing beautifully. It's growing earnings at high single to double digit rates. It's forecast to continue to grow earnings at a rate excessive of 6% for the next 3 to 5 years, and now it's undervalued, and most people don't want to look at the stock now because it's cheap. Moving right along here, let's look at Philip Morris International. We already looked at Altria, and once again you can see how the price tracks earnings over all these years. Then we get overvalued, and now we've got this correction going on where the price is coming back down to a more normal 16.7 times earnings. I'm going to next look at PPG Industries, a specialty chemical company. You can see the valuation got extended, and once again we've got 2 or 3 years of virtually no performance as a result of the valuation getting high. Starbucks, one of the classic growth stocks of our era, you can see how it had a long extended period of high valuation, but then in 2015 to current, it's actually generated a negative rate of return over what's almost a 3 year period of time here. Again, it had nothing to do with the business. The business was doing fine. You can see the growth of the business here by looking at how the orange line is accelerating. The only thing that was wrong here was valuation got excessive. With my next example, I'm going to look at J.M. Smucker and Company. Again, a premiumly valued blue chip dividend growth stock. The valuation got real high, and we've had this reversion to the mean, or you will, or correction. Now we can buy this stock at a very attractive valuation with a 3% dividend yield, where just a year or two ago it was overvalued. Similar with Stanley Black & Decker. Look how close the correlation of price and earnings are on this particular example. Then we had this irrational, exuberant period, and since December of 2017, we've had this pretty dramatic correction here of 18% correction for this year. And again, not because the business was doing badly, it's still doing great, simply because of the headwinds of overvaluation. I talked about Visa, and I wasn't going to include Visa, but I thought I would. When I bought Visa, it was May of 2011. I paid around $20 a share for it. Okay, and since that time, my rate of return has averaged over 30% a year. However, if I looked at Visa from what it was doing, people talked about losers. The stock had actually a negative 11% rate of return for actually what was a little over a year here. And I bought it when it was cheap, and that's how I've made the return. I'm still holding Visa, but I'm fully aware of the fact that the stock is no longer inexpensive, and so I'm watching it. Walgreens is another classic example of high valuation leading to extended long-term poor rates of return, actually negative rates of return, even though the business actually performed beautifully during this period of time. It was simply the headwinds of overvaluation. The stock got overvalued again in 2015, and now we've seen a 32% correction in the price, and now the stock is cheap, and nobody likes Walgreens today. When it's cheap, they hate it. When it's expensive, they love it. Wisconsin Energy, or WEC Energy, is one of my favorite utilities. It has one of the fastest or highest growth rates of any utility. I just see the stock getting overextended right now, and you can almost see how, valuation has stalled performance over the last year or two. Ultimately, I think the stock goes back to the orange line, but I can't time that perfectly. I simply cannot know when. And then, of course, Walmart, we'll call it last but not least, is a story very similar to what we saw with Walgreens and Medtronic. We had extremely high valuations in 1999 and 2000, the irrational exuberant period. Those high valuations, even after they subsided a little bit, led to an extended period of time of very weak returns. And again, during a period when the business actually did extremely well. Valuation has a material impact on how your investment's going to do. And the idea is, when I see high valuation, I'm simply aware of that. We saw it just even more recently when by January of last year, Walmart got extremely overvalued again with a PE of 24. We're now back down to a PE of 19. And so far, that's led to about a 17.5% to 18% correction. Valuation matters a lot. This has been Chuck Carnevale saying thanks for watching. I'm just trying very simply with this video illustrate that you can recognize overvaluation when it occurs, and you can take appropriate steps when that happens. Sometimes that means selling the stock. Sometimes that means just watching it more closely. But your expectation should be based on the mathematical realities of what the stock is capable of generating going forward. And, I simply created this tool myself so I can run those numbers if I look at a rational market, what the stock can be. But I can also value the stock based on things like normal PE ratios and run what-if scenarios. But the key is I'm investing with my eyes wide open. I know whether my valuations make sense or not, and therefore I'm behaving accordingly. If you enjoyed this article and found the fast graphs fascinating, you might give us a call at 813-960-9600 or go to www.fastgraphs.com, and you can take a 14-day free trial and learn more about how fast graphs work and how they can help you be a better investor. It's been Chuck Carnevale saying thanks for watching.